this is John Kvale of JK Financial, and this is our September 2015 capital market and economic review that we do on our blog post. It's a monthly review. We're going to be short, this time because we do have a quarterly newsletter that comes out, but we wanted to get you the month's activities, and there were some. So here we go. Okay, so here is the post, the September blog post for our economic and financial review. And here is our financial planning tip. This is something that we do regularly check with folks, and we wanted to remind everyone in case they have slipped up. We want to max our retirement funds out before the end of the year. Whatever our scheduled maximum is, now is a great time to check it out. So, for example, we're entering the fourth quarter. We just finished with the third. Most normal plans, if you're under the age of, most popular plans, if you're under the age of 50, the maximum is $18,000 that you can contribute. That's a 401k, 403b, 457, those type of plans. There are some caveats in there, so your situation may be slightly different. If we're 50, we can put in another $6,000, moving that up to $24,000. All right, so I say ideally here we should be 75% of the way. That's pretty straightforward, 3/4, 75% of the way. So take a look at your year-to-date pay stub. If you want to help, if you want us to do a calculation, just let us know. Send us the year-to-date pay stub. We'll do an estimate and make sure that we're maxing that out, or whatever our goal is to max out. And just remember, the reason that we do this is for every dollar that we put in there, about 30 cents does not go to Uncle Sam. So I say down here, we either use it or lose it. It's a great plan for us to use. Now's the time to check it and make sure we max out. And you may have to accelerate or decelerate, and we'll make notes of that so that in January we'll get us back on track if necessary. All right, I just thought about this. Just change this picture out. I hope everybody enjoys the picture because I think it's very fitting. And that is that the world was ready. Many say that we weren't, but I thought we were. Donald said no, but we were ready for our interest rate hike. Economists polled were over half. Just at the Jackson Hole week, a couple of weeks earlier, or weekend, the FOMC, I listened to just hours upon hours of interviews with Fed officials. They said, we're going to raise. We thought we were going to raise. Rates moved up, and yikes, just like Lucy did with Charlie, they didn't. After the press release, Janet explained that she didn't raise because the world wasn't ready. We were slowing economically, slow. Things are a little bit slow. Okay, so we're slow. This is pretty slick. So I say, what did markets do after Janet painted a gloomy picture? Well, they got gloomy too. Her announcement was back over in here, so we had some moves already. But this is basically a good proxy for the total world markets, and they're down for the quarter about 10%. And as you can see, that it wasn't just over here and then down, and Janet made everything good. But it was in here. We certainly got a lot of volatility, and this is where we are as of the end of the quarter. So I do, in all fairness, say, there's no way to tell if this is cause and effect or just coincidence, but it did happen. And maybe it was going to happen anyway, but I think the preponderance of people that I talk to are ready for an interest rate hike. So, and I think I have a sneaking idea, and this is for all those folks that are listening to the video or listening to the audio. I have a sneaking idea that when they do raise, if the world's not going to come to an end, we may actually get a relief. This may actually get a relief. So, could be, could not. Again, we have the newsletter coming up, and it also comes with a video, so we're going to keep this one short. We thank you, as always, for your time. Have an awesome day and a good start to the fourth quarter. Thanks.